All right. Good morning, everybody. You know, it actually feels like a Friday. How's that, huh? Maybe getting back in sync. So earlier this week, I was talking about the opportunity for a capitulation low, but we needed one last hurrah, a big dump down, and then a rally back up. And while we still have QRA and FOMC May 1st, I like how this is starting. So really something to consider is, the old phrase, buy when there's blood in the streets and buy when everybody else is scared. If you look at all of the red today, it would seem, pretty negative. But we've already come back up a long ways from the drop down in the overnight hours, except for Japan. The poor thing has been beat down. We've seen, -4s and -5s. Now we're seeing -6, close to -7. This has been just a continuous, nonstop beat down in Japan, and I don't think it's done yet. It's been like 19 days straight since we've gotten to April, when this thing has just been beat down. It's where the biggest brick in the wall of worry is at, too. I would say it's so big, it's almost its own wall at this point. Europe is down. I mean, everything is down, but the question is, which ones are coming back the fastest? That's what we want to focus on this morning. If, and I really want you guys to consider that, if this is the capitulation low, right, we hit that 20-week, we've rebounded nicely back up to where we closed yesterday. What are we going to get, going forward from here, at least into the blackout period and then FOMC? We have another Fed speaker today, Goolsby, but for the US, that's just about all that they're showing here on Market Watch, which is fine. Market Watch generally doesn't try to get every single event, right? We've covered that more and more often. So looking at FX Street, you can see there's really just not a whole lot on the table today, which is another reason that I think this could be one of those capitulation, rebound, rally kind of days. The thing about the indexes, trading the S&P and the NASDAQ, it's a lot like Mahjong, that game where you try to recognize picture patterns and pair them up. There's only so many types of days that you're going to get in the indexes. Every once in a while, you'll see something really new that you haven't seen before. But for the most part, they are just days that repeat over and over and over again. And if you can begin to recognize early enough in the day what kind of day today is, you'll have a really good roadmap on what our expectations are for the rest of the day. So as we can see here, we really don't have a whole lot going on, and we don't see really any auctions either. Okay, going to be another quiet one, or possibly the first of a quiet day. We haven't had one in a while. We got Bank of England chipping teeth, and then we've got Goolsby here in the US, Bank of England again, and European central banks later in the day around 2 o'clock. Well, it's actually 3 o'clock because these are my time zones. Unfortunately, I can't change them for the stream. So there's still a lot of tension in the Middle East. No surprise. But the drama that dropped the markets overnight seems to have been, just algos, and that's basically been reset. So we're back where we started on that front. Even though price is back where it started, I still want to argue the opportunity for a change in structure. We might be back where we started, but we needed that breakdown, and we got it. We're going to get rig counts today. This number generally doesn't change all that much. think it's sitting like at around 106. I was thinking of Canada's numbers. These numbers don't change that much. So they may adjust by 7 or 8 rigs when they take them offline to work on them, but otherwise, unless something really drastic goes wrong, that number isn't going to be altered much. I worked on those rigs for most of my life. We have elevated volume this morning, and they are hedging. Now, earlier in the week, we saw 183, and this morning it's 178. So, you know, it's not the biggest that we've seen in all of this, but it's a pretty heavy day. These 2 days, this 183 and this 178, these are the biggest days that we've seen this year, I think. But we can scroll back and look, but I'm pretty sure that we haven't had more overnight volume at any point in 2024 than we have in this week. It's worth taking a look at what kind of trading day we had on that day where we had 183 volume in the overnight. It's a lot of trash. Powell came in at 1 o'clock that day, if you guys remember, and spiked the market, but he wasn't able to really do anything with it. Or I should say he wasn't interested in doing anything with it, because if he wanted to, he'd have done something. So it was just a whole bunch of hurry up and wait all day long, waiting on Powell. And then after that day, the next day, we finally got the move that we needed to get out of that range. This has just been a slow, steady grind to the downside. Here we're looking at a weekly chart. You can see that 20 period at 5,000. We got it. We held it. We're back above it. We need to keep above it. Now there's a market logic and a lot of analysts that talk about, first time is a bounce, the second time we break, and then down we go. And that's true if we're going to maintain that bearish posture. And we can see it back here where we came down, we tagged that 20, bounced up, and we cut through it. Made it into the 50 and even below the 50. So it can get more nasty than what we've got so far. Just keep in mind that was an August bounce, and then we broke through around mid to late September into October, and then we had the QRA in November. Our time frame is a little different because we've got QRA May 1st. It's 2 weeks, not months. This could be a capitulation low. Here we're on a daily chart. I like this kind of recovery bar, and it doesn't mean necessarily that I think, that we're done and we're going to rally back up to 53.40 and expand higher from there. It's not quite really what I'm saying, but if you find these examples where we've had this really deep pin bar style move on the S&P after 4, 5, 6 days in a row of negative, the recovery is impressive. There's a couple of these that you can find when you go looking into the past. They're not all red pin bars. Some of them are green. This one would kind of fit the bill. We're not all the way through the day yet, but think it through from the point that we've already dipped down, we've come back up, and since we haven't rallied yet, our bar isn't green yet. But that's the kind of move that we're looking for. I mentioned this earlier in the week. I was looking for this particular day to happen. And what do you know? We got it, right? I wasn't quite sure we were going to get it this week, or maybe it was going to be next week. There's another one of those examples. It's not as big, but pretty decent pin bar down into the moving average and back up out of it. I think the NASDAQ's got a couple of better examples than this, maybe on the SPY instead of looking at the ES. It's just technical analysis, right? So it's not too hard to go and find examples. Now that this bar has been created, there's a couple of things that we can do to kind of continue to ask that question, is everything on track? If this is our capitulation low with a pin bar reversal, what needs to happen and what should not happen? Well, one of the things we should not do is come back down below this 50% mark. Now, if you want to be even more strict than that, you could add something like the 786 here and just say it needs to hold above that. You could mark yesterday's low, and now that we are back inside of yesterday's range, we could just say it needs to stay inside of yesterday's range, and it should not break back outside of yesterday's range. We went inside day breakout and we've recovered. It needs to keep it. So there's a couple of things that we can line up in that side of things. How about for the other direction to continue to go higher? Now that we have pulled this move off and we're back to where we started, what do we need from here? We can do the same thing. Look for the half back of yesterday. We need to get through the half back and then challenge yesterday's high. Get our breakout above that. Unfortunately, we've got to get through the 3-day, the 10-day, 20-day, 50-day. And the fact that we're underneath the 50 and the 10 is underneath the 50, it doesn't bode well for a recovery back up into like 5,300 and all of that. There's just too much damage done, and it's going to take a while to get back up there. If we can even get back up there this quarter, that's a big if, and it's going to be, really dependent on FOMC and QRA coming up. If you go back and look at all the times where the 10 got below the 50, we tend to had a hard time turning things around. It took a while to turn things around when that happens. And that's where we're at now. It's just going to take time. So I'm not suggesting everybody go out and go long and try to run this sucker back up again. We're not there yet. But for today, to get at least one good green day after all these red days, oh, we're primed and ready for it. It absolutely could be one of those days today. One of those days where we keep going and everybody thinks there's no way we can go any higher from here. And then we just keep going and we keep going. So we've talked about the downside moves that we do not want to see, those kind of lines in the sand where it needs to stay above. And speaking of those levels that we need to stay above, we're back above the put wall this morning. We need to keep that. I'm really surprised that it's still there. I really thought they would have rolled that in the overnight hours, and they didn't. So that's a bit of a surprise. Now, I don't have the AM edition of the founder's notes yet, so can't say, one way or the other if we're going to see something like that, if it's going to get moved anyways. But the levels aren't really connected to the founder's notes, so they shouldn't move for us. We still have a daily pivot. This is a floor pivot, and so far we have not hit it, which makes it an MDP, missed daily pivot. I don't think it's going to stay missed, though. I think we're going to come up and hit that. We've already cut through the ADR low, both of them, and recovered back inside. If we hit the ADR really early in the morning, one side or the other, then we can go to the other side by the end of the day. One more check mark in the thing that says, I think we can rally today. We've been maintaining above VWAP since the midnight reset. So that's another check mark. It's also another line in the sand if you want to continue to focus on a bullish bias, really want to keep it maintaining above that VWAP. Now, even on a good bullish day, we can cut down below the VWAP. But once we start to really outpace it, we don't want to come back to it anytime soon. You can always go back and find old examples where we outran the VWAP. And on those days, we really don't want to come back to it. Right? Here's a perfect example of that, where we started to outpace it and then topped out, had a really nice reversal signal, and we came back to VWAP. Well, so far, we're still with it. We haven't started to really outrun it yet. The ADR low is 50.78. If we can cut through that, we've got a voodoo line at 50.88. Yesterday's RTH at 50.95. The full ADR 51.08, which is really close to the COG line 51.11. So I'd probably just focus on 51.11. We got the 3-week, the 10-day, and the 10-week all over our head here to deal with. If we can get through all of that, we have 0 gamma and the volatility trigger to deal with. And then we have last week's low, because we're still inside week breakout to the downside. Remember that weekly chart? We're talking about the ability to rally all the way back up today through this 10-week and back inside last week's low. The 50% mark, or the halfback, is 52.17. It seems like a long ways off compared to where we are right now. But if it turns out to be one of those kind of days, it's within reach. I don't think it's going to get that good, though. Let's just start with getting back to the high of yesterday and maybe getting into the COG line at 51.11. There is a little bit of concern with the hedging this morning because, as we've already shown, there's really nothing on the docket today. So why are they hedging? Remember, hedging is cost. It's not like when retail traders decide they want to go hedge something and they put on some kind of trade and then it's just a trade and it really doesn't have much cost behind it. When they hedge, it's literally an expense. They're not going to spend that money unless they feel they need it. They're worried about something. And it's odd that they're hedging at the same time that we have all of this volume. Now, it is OpEx, and that could have a little bit to do with the hedging that we see. It could, a little bit. It could, but I don't think that that's the whole answer, right? Not on its own. We have seen that on triple witching, how the market maker move will be affected at that point. For those who are new and haven't had this discussed yet, what we're looking at is the market maker move on Thinkorswim. And what the market maker move does is looks at the front expiring options implied volatility average and compares it to the next series out. If the front number is higher than the next series out, then you have a market maker move. If you want to read more about that, there's a website called the Ticker Tape, which was run by TD Ameritrade, and you can search Market Maker Move on that website. They'll explain it in really great detail, but they only ever talk about using it for things like earnings or investor day events or drug trials and things like that. They never mention the futures at all, as far as I can remember. To me, it's a glaring oversight because it's so absolutely valuable to being able to spot when they're hedging. If you don't know how this number is calculated, uh, some of it's proprietary. They don't give us all of the details, but we know some of the ingredients. It uses time, the square root of time as a part of the formula, and they use all of the implied volatility numbers from the out of the money puts and from the out of the money calls. We know that those are all a part of the ingredients. And so what happens is the firms come in, they'll hedge by using these out of the money options. That volume and that trading activity triggers an increase in the implied volatility average on the side. And if they're doing it in the front end, then they'll end up with a market maker move because it'll push the front end's implied volatility average higher than the next series out. Now we could say, well, maybe it's hedging. And honestly, yeah, maybe it is. One thing that we can do is continue to watch this and see if the volume begins to increase higher than the open interest, like right there. If the volume is matching the open interest, the argument for a roll makes perfect sense. But if the volume is far and away above the open interest, then they're not rolling that. They're trading that, especially if it's a 0 day. Same with that one, right? And we can pick and choose a little bit here and there, but we would want to see more and more evidence of this, right? That it continues to increase. That way we can answer it for sure. Is it OpEx or not? Because that is a really fair question. It honestly could be OpEx, but I don't think it is. $10-day, 30-minute volume profile. We had a nice dip down, which has now widened our profile out again. 5,000 on the low end, 52.85 on the upper end. It's a really wide profile. There's been times this year when this profile was like 50 points, really compressed and tight. We've left the point of control behind. It's not quite lined up with the TPO's point of control, but it's getting close. And we should not see a move or a reset or a change in this point of control for at least another 3 days. Even if we stayed right where we're at for the next 3 days, building up volume at this location, we still wouldn't lose enough volume across these highs to bring that point of control down yet. We also don't really have a classic profile here. You know, normally it would be something like P, B, D. It'd be one of those profiles. Except that we have this tail down here. It is worth noting that the greatest amount of the volume is in the upper part of the profile, but we have to get through that. It's just one more thing to add to the list of all the other things that we would have to get through for any sort of really good rally back up. It's going to take quite a bit of time. We did get down into the VPOC last night, so a good example of why we keep that on the chart. You can see price didn't come down and hit it exactly perfectly right on the penny, right on the tick. We overshot it just a little bit before bouncing back up. And we ended up going back down through it again. But if I was trading it last night, I would have wanted to know where that line was. It has been hit now. It's done. We take that one off. Now we could argue that we get a new VPOC from last night, but we opened and cut right into it. Now, some analysts will say it's okay, I'm going to put it on there anyways. And you could just carry forward the point of control, not as a VPOC, but just as a POC, a point of control. Every textbook that talks about volume profile will say, sure, go ahead and carry that forward. I don't want to. I only want an untouched point of control. And this one's already been hit, not just with one candle either. We were there for, what, a good 30 minutes. We cut through that zone. It's done. So as far as I'm concerned, it's not an untouched point of control now. So I don't want it. But if you want all of the pivot points that you can get, marking every single thing out that you can mark, then you're going to want to mark that and carry it forward. Looking at the profile this morning, we don't really have anything here either. If there was something here, we would have more of one of those classic shapes, D or P, that we already had discussed. I was really hoping they would get the founders note out at least one time this week before I'm done with my morning briefing. They've been late all week. Whatever. All right, now we are considerably outside the box. And because it's Friday, we already have the box for next week. Now, next week's box is not set in stone. It won't be until 4:15 tonight. We're getting a glimpse of where that box is and what it might look like, the size of that box. Before we get to that box, let's just focus on the box that we had this week. This box is a 1 standard deviation. So just to kind of give you an image, this is the image of a 1 standard deviation. Generally, you would see this standing up and down instead of running from left to right. Has a probability range of 68.27. We always just round up and say 70%. That 70% when it comes to the ES is a little off. The ES is such an accurate expected move player that it generally closes inside that 1 standard deviation 80% of the time, not 70% of the time. And the reason I showed you that curve is because what happens if we expand too far out of the box? Well, first, arbitrarily, what's too far? One more standard deviation, 2 standard deviations, 3. If we go too far, then we'll trigger selling and they'll sell into selling. And that will force them to sell even more. And then they'll sell into selling because of that selling. They're trying to get back to delta neutral. It can cause a feedback loop. We didn't trigger that, but we got close. So now the question is, are we going to get back inside this box or not? Statistically, we've got an 80% chance of being back in that box by the end of the day. It's not bad. I wouldn't run on that alone, but it is worth thinking about, especially when we add the fact that it's a pin bar reversal off of the 20-week, that it was the capitulation low that we had been looking for and that I'd honestly been talking about earlier in the week. And that there seems to be at least a smaller amount of, how do they say, there's a bit of a de-escalation, hopefully at this point, right? A little tit for tat, and maybe both sides can calm down and relax a little bit, maybe. And that things might not escalate any worse. Knock on wood. So we got a number of reasons to believe that this could rally up today and get back inside the box. There is a warning though that I wanted to add to this. And just like back here, you know, we opened gapped down, or we opened up, but not up by much. We fell down, closed the gap, and then we rallied up and we got back in the box on that Friday at the end of the day. But it can be a resistance. So we could have just ran up and hit our head there and failed to get back inside the box and stalled out. It's really going to be whatever they're hedging against this morning with this market maker move, and then how they respond with these put walls, because a lot of things got flushed out. But if we're back up here when we get into the open, the S&P was closed all night, right? So it didn't wash anything out. I know the CBOE is running a 24-hour a day SPX now, but I've dug into that. And sure, the SPX is open around the world, but it's not open for the US at 24 hours a day unless you've got access to it from a specific broker. And it's not Fidelity, it's not Schwab, it's not TD Ameritrade. They don't let you trade the SPX 24 hours a day. But the SPX is tradable now. Those options are. We won't see it though till the open, right? But we know what the SPX has been doing. Same thing as what SPY has been doing. Same thing as what the ES has been doing. Now the ES has almost got the gap closed, right? From where we closed last night. And the easiest way to be able to answer that question, because depending on the broker, what are you going to use for close? The 4 o'clock close, the 4:15 close, the 5 o'clock close, or are you just going to use the 6 o'clock OpEx open? Easiest way to mark the close is to go out to the daily chart. Look at what the broker called the close, 50.48. We're at 50.42. We've almost got that gap closed already. Look, we ran up and just barely missed it. So is the SPX going to fill that gap? I mean, by the time we open, we could very likely be back above 50.50, and there would be no gap to close on the SPX. We'd already be up there. Then we would look ahead and look up at all the other gaps on the SPX. There are a lot of gaps. So we could start focusing on those, but there's also this lower gap that needs to be resolved. I love it when Zoom jumps in my way and stops me from grabbing this. There's this big channel here on the SPX. $49.81.81. That is the gap close that I've really been focused on. Depending on where we open at 9:30, we could be gapped down on the SPX, and it could finish this and then come back up. But so far, it's not looking like that. It's looking like we're going to open either near where we closed or above where we closed in the ES. And if the ES opens that way, so should the SPX. And so it won't have that gap closed. So one of the concerns that we have today is US dollar Japan above 154.5. It's kind of a really big deal. Watch for an inside day breakout. If we get above this peak of yesterday, that high of yesterday, that's going to cause a little bit of grief in the market. Keep your eye on the dollar index, the Dixie, DXY. We really don't want to see this thing get above its own Globex high here from last night. We'd preferably like to see it break this 3-day and continue to fade to the downside. No fast, sudden movements though, right? Just a nice, gentle grind to the downside would be more than enough, be just fine. We've been seeing weakness in the Dixie, while we've also been seeing weakness in the S&P and the NASDAQ. So this isn't on its own going to be some kind of teeter-totter where the Dixie goes down and the S&P goes up. It's not going to be that kind of move, right? But we want to see the dollar fading. We want to see US dollar Japan not break out and continue to go higher. And same thing with the 10-year. Needs to stay underneath this 3-day moving average, preferably get back to this 10-day and just ease on back away from that 4.6 range. Yields are getting into some tenuous spaces. So we just need everything to back away and calm down. Especially if we're going to look for a rally today. Just keep in mind, swing traders, that we're not talking about, coming back out of these lows for a run back to the highs. That's not what today's discussion is. It's just, can we get a rally today after that really nice pin bar reversal on the ES? It's one of those one-day wonders where we run 2% to the upside. Yeah, today we could. We've got all the ingredients. The only thing that we're missing at this point is the rising tide that lifts all boats, right? So things that are down this morning that won't be helping us: the Mag 7, China ADRs, semiconductors. We're not going to get any help out of that group yet. They're not positive. Things that are up, what's that? Bitcoin, more Bitcoin, bonds, and that's it. Bitcoin and bonds, that's not going to do it. I wouldn't be surprised if we have pot stocks up as well. They just don't show on Thinkorswim. Airlines are down, uranium, China, semiconductors, more China, crude, more China again. All of those are down. But when it comes to things like semiconductors and them being down, as long as they're trying to come back up as a part of that capitulation low rally back, unlike Thinkorswim, TrendSpider shows on the daily chart this pre-market move, which I love that. So we can see that semiconductors did gap down. They're already started to try to rally back up. Bitcoin's trying to continue that move that it started yesterday. So a nice rally back up, gap up this morning, inside day breakout. It's trying to continue that push. Biotechnology, red to green, closed way down here at 124.5. We're gapped up above 125.5. We're not inside day breakout yet, but that's a good start. The thing is, it's just a print. We don't have flows here yet. We don't have any follow through. And so that one little print is not enough. Bonds are up. It's a nice gap up this morning, but it failed to inside day breakout. We want to get that follow through. We want that breakout. That is looking like a bear pennant down here. So it'd be nice to get like a bear pennant or bear flag failure where we break out above, call it 89.5 and try to get back into 91.5. Everything that's in the middle needs to giddy up and go, right? Do the thing. It's kind of what we're waiting on. Yeah, probably shouldn't have clicked on that. I tried to put the front end in there and it didn't like it. Symbol not supported. You reckon? So even pot stocks have made the dip and turned around this morning. If we're going to see that move today, then we're going to want to use something like the Visualize tab. This is really useful. Forget the heat map, swap that out for the index watch. This is now an advanced decline line, but it has money in it. So it's an advanced decline order flow with money. So issues are companies. We can swap this over to, say, the NASDAQ 100. It'll have 101 companies because Google's in there twice. And we can see how many companies are going up versus how many companies are going down and how much money is coming into the market, meaning they're going in with the buying, or how much money is leaving the market, or how much is going with the selling. This is where I often spot divergence. There'll be, say, 30 issues or 30 companies going up, 71 going down, and yet there'll be more money coming into the market than out of the market. And we slowly start to turn that advanced decline around, where we end up later in the day with 70 advancing and 31 declining, something like that, right? It turns and flips. These are detachable, by the way, so you can load up more than one. Scrunch them down. They don't really need to take up much space unless you want to see all the bars that are going to show up here with the matching all these companies. I don't need that visual aid, right? I just want this part. And so you can stack these things up. And that way you can watch as many indexes as you want. The S&P, the NASDAQ, you can even put your own index in there or make, like a Mag 7 index and your portfolio, whatever. So today, if we're going to have one of those days, one of those ripping rallies that just doesn't stop and gives a good 1.5%, 2% move, we're going to want a dominant advanced decline line today. At least 90 names to the upside, nothing less. And if we get into 98 or 99 names, consider running the alpha protocol. If you haven't heard me talk about that, well, that's something for another day. But 90 plus advancing names in the NASDAQ and or the S&P, preferably both, we'll have a pretty good opportunity for one of those days. Keep your eye on the market maker move as well. If it starts to drop, then it's likely whatever they were concerned about has passed. If it continues all the way into noon, past noon and onto the other side of lunch, then it's very likely that they're going to run it for the rest of the day. And it will shrink just because we'll have less time as the day goes on. So when I say watching it drop, we're looking for it to drop significantly. It's at 0.55%. If it drops down to 0.15% by 9:30, then whatever event there was has passed. But if it's just slowly dropping lower and lower, 1 percentage point, every hour kind of thing, just gradually decreasing, well, that's just time getting pulled out of it. Because this is a 1-day thing. It's only for today. It's adding an additional 0.5% to today's range of how far we could move today just based on expected move. So we take something like the ADR, which is 1.22%, and we add another 0.56%. That's it. It's as simple as that. Everybody, be careful, be safe, have a good weekend. I will see you all next week.